some pressure for the frontliners, mostly courtesy of what's happening on IT today. TCS down 3.5%, a bunch of the other guys as well struggling. Also, those big moves that you saw on infrastructure are coming apart today. So BHEL and L&T are down about 2%, and banks generally are not holding up very well. Let's see how the day progresses, but private sector names like ICICI and Axis are also in the red. HDFC reported its numbers today, which looked fine. KK Mistry joins in to talk about that. KK, morning. First, a word on the margin performance this time round and spreads as well. Sequentially, it looks quite stable. Can that hold, do you think, for the rest of the year?
If you ask me, today we don't expect any change in spreads. Let's talk of the two differently. Let's first talk of spreads and then talk of margins. Now, if you look at spreads really represents the difference between lending rates and borrowing rates. And if you take the last 10 years, you'll see that spreads have remained in the range of a low of 2.15 to a high of 2.35. And if you take the last 4 to 5 years, spreads have been between 2.25 and 2.35%. So we don't expect that to change. Our expectation is spreads will remain in the same range. Now, when you talk of net interest income, you talk of NIM, net interest margin. Net interest margin takes into account a whole lot of other things. For example, we have sold loans. Now, the total stock of loans that have been sold by us aggregate now to 14,556 crores. On this 14,556 crores, we will continue to receive income. The weighted average income that we receive on these loans is 1.53%. So we will continue to receive this 1.53% as long as the loans remain outstanding. So we are earning income on loans which are not there in the balance sheet, and that then tends to increase the net interest margin.
KK, morning. What's the loan growth picture looking like? Because there are some signs across categories that consumption is beginning to wane a little bit. Are you seeing any pressure points?
See, you have to look at it this way, that for a person buying a house in India, it is the single largest investment, or it's the single largest investment he makes in his lifetime. And he's buying a house not because it's a speculative activity, not because it's something that is desirable. He's buying it because it is something which is essential, it is necessary for him. The average age of a customer when he takes a loan from HDFC is 35. It's not people in the 20s like in the West who take loans. It's people in the mid-30s who are taking loans. And today we know that 60% of the Indian population is below 30 years of age. So all these young people will over the next 5, 10, 15 years need housing and therefore housing loans. So we are reasonably confident that unless we get to a situation where people start losing jobs, as long as we don't see that kind of a situation, we should continue to expect a growth in line with what we expected last year, which was around 18%. Our guidance has always been around 18% growth. In reality, we have grown at a faster pace in all these last 3-4 years.
Can you give us some sense of how demand is shaping up across categories of cities, including metros like Mumbai?
See, demand has been strong in almost every part of the country, with the exception of Mumbai and with the exception of maybe 2 or 3 pockets in some of the larger cities. But on a pan-India basis, demand has remained strong everywhere. The Tier 2, Tier 3 cities have seen a faster growth than the Tier 1 cities, but that emanates out of the fact that the base number is smaller. So obviously a percentage growth would look larger. But the big cities also continue to grow well, barring Mumbai. If you look at the breakdown of a city-wise breakdown of our lending in this year, the Delhi NCR region would be the largest. Chennai would be the second largest. Mumbai would be the third largest. And then we would have Bangalore and Pune.
It's a large market though, KK. Can you just quantify the kind of slowdown you've seen in the Mumbai and ancillary region, and whether or not you expect prices as well to start moving lower?
See, Mumbai's biggest problem is the fact that the supply of real estate is very limited. And the reason property price is because of the fact that the demand always is higher than the supply. Now, again, the only way, in my view, proper way, is if we were to dramatically increase the amount of supply. And that can happen only if the infrastructure improves in a big way. For infrastructure to improve, you need better connectivity, better roads, connecting the northern part of the city with the southern part of the city, probably from both sides, east and west, and then with several inlets into the city. And if you were to do that, and you were to improve the water, the sewage, the better educational facilities, health centers, hospitals, so on and so forth, then you could permit buildings to go higher, and that would increase supply and logically bring prices down. But other than that, Bombay prices are unlikely to fall in any big way. Now, where is Bombay's biggest, so the Bombay's biggest problem is the lack of supply.
Sudden turn for the market, so just keep an eye out on that. Not a huge fall, but it has come off considerably from where we opened up. So the Nifty is now sub 5100. In fact, the mid-cap index is in the risk of dipping into the red after having traded up nearly 3/4 of a percentage point. Brent suddenly got a whole lot tighter. Just watch the market; it's gotten a bit volatile. Keki, for the banking space, people were a bit surprised at how little the flow-through was for many banks in terms of what the Reserve Bank decided to do on cuts and how little got transferred to the system. What did you make of that? And is HDFC itself considering more rate cuts?
It's a function of liquidity in the system. See, RBI has cut rates by 50 basis points, but if you actually look at bond rates in the market, if you look at AAA paper, for example, interest rates today in the market are actually the same or maybe even a little higher, a few basis points higher than what they were before the credit policy. So liquidity continues to remain tight, and because liquidity has been tight, interest rates have remained high. Now, as far as we are concerned, whenever our cost of funding reduces, we will definitely pass on the benefit of lower funding to our borrowers. When interest rates were going up the last two or three times that RBI increased interest rates, we did not increase our interest rates because our cost of funding did not go up in a manner which would warrant an increase in interest rates. So whenever the costs come down, definitely we'll pass on the benefit. I would expect that in the second half of the year, we would hopefully see lower inflation figures. If you take a look at oil prices, for example, oil which used to run at $120 to $123 a barrel not too long ago, is now today back to around $112 a barrel. So that's a very sharp pullback in oil prices, and that at the end of the day is going to be one of the major determinants in the inflation figure that we will get. So if inflation remains low, interest rates will obviously come down.
Thanks, Keki. Appreciate you joining in as always. The Nifty is indeed back 40 points now to 5,073. Still